Good evening, and welcome to tonight's market briefing. Let's start with the numbers that matter. The NASDAQ closed at 25,520, essentially flat. The S&P 500 and the Dow Jones also saw minimal changes. But don't let those surface-level numbers fool you. The VIX, our fear gauge, sits at 18.77. While it didn't move much today, it has surged more than 12% over the past 7 sessions. That tells us one thing clearly: risk aversion is building fast. Now, the real story today, without a doubt, is what happened in China's A-share market. The Chi-Next index, which tracks high-growth tech stocks in Shenzhen, crashed more than 7% in a single session. The Shenzhen Composite Index has now lost nearly 9% over the past 7 trading days. That drop has triggered our anomaly verification protocol. We haven't found a single trigger, but the weekend news flow did the damage. The US announced new restrictions on HBM chip exports, and the Netherlands tightened controls on ASML service and maintenance agreements. For Chinese tech investors, that was the breaking point. We saw panic selling, indiscriminate dumping, especially in high-valuation growth names. Here is where it gets interesting. That massive sell-off in Asia did not cause a corresponding meltdown in US futures. In fact, NASDAQ futures actually bounced slightly after the A-share close, up about 0.2%. This divergence is rare and significant. It suggests that US markets are currently more focused on earnings season and their own fundamental drivers. They are not treating the A-share panic as a systemic risk contagion. That said, we are not out of the woods yet. When Wall Street opens tonight, tech stocks, particularly semiconductor names like AMD and Nvidia, will still face headline risk and residual sentiment pressure from Asia. Let's look at the other asset classes. Oil was the clear winner today. WTI crude rallied nearly 3%, closing above $84 a barrel. Geopolitical tensions in the Middle East, combined with ongoing supply concerns, are driving a concentrated flow of capital into the energy sector. Gold, on the other hand, slipped a bit, trading around $4,000 an ounce. This tells us that investors are not blindly piling into all safe havens. They are being selective. The US dollar index edged higher to 100.84. But here is the key point: the Chinese yuan held relatively steady against the dollar. That is an important signal. It means today's panic in Chinese stocks was primarily a domestic emotional explosion, not a capital flight-driven currency crisis. So what is the big picture? Today was a day of extreme structural divergence. The money flow is crystal clear. Capital is fleeing high-valuation tech and growth stocks and rotating into energy and select defensive assets. The pricing gap between Chinese tech stocks and US tech stocks is now unusually wide. In our experience, that kind of divergence typically signals either a near-term catch-up move or a much larger volatility event ahead. Here is our call for the next 24 hours. For the A-share market tomorrow, we expect a sharp divergence within the index. The Shanghai Composite could fall another 1 to 2% on emotional inertia, but a bottom-fishing bounce is not out of the question. For crude oil, we see profit-taking pressure building. Expect a pullback into the $82 to $84 range over the next session or two. And for US tech stocks tonight, the key is whether they can hold the line. If they can absorb the Asian panic without a major breakdown, that will be the first real signal that risk sentiment has found a floor. For now, the prudent strategy is to stand aside. Wait for the panic to fully exhaust itself. Wait for a clear signal before stepping back in.